there's a much stronger correlation between NIAC and increase in MVA than any of the other measures that are typically employed. And again, this shows, with NIAC in the middle, its correlation. While it's not perfect, it is a heck of a lot better than the others. And you have the handouts in your binders, so my hope is that what this becomes also is a place for you to continue learning about this. And pay attention to the correlations. If you have a measure that's a lot better, let Mr. Barksdale know here, and he'll be sure. Let me introduce Don, by the way, if you could stand up for 1 second. He was out of the room when we started. This is Don Barksdale, and Don Barksdale does a lot of the, what would you describe your job as, Don? Financial modeling and yeah. So if any of you want a financial model built, not a financial plan, by the way, there's a difference. But today, Don is Vanna, and he's here to answer all your questions, particularly the tough ones. So let me show you an example. This is a sample loan portfolio. So we're going to play a little bit of a game here and walk you through this. There are 6 sample loans. And they're all the same, basically, with the exception of their expenses are different on each loan. So by applying different decision rules, depending upon where we were focused, the question is what creates the most value. So you can see up here, net income after tax is one line, return on equity is another line, net income after capital charge is another line, and you can see the capital charge here, and that's essentially where we've charged for the cost of the capital that's employed in making loans. And today, you want to give the exact number, Don, for the charge?
11.63.
Thank you. 12%. So, right there. So if you were going to make these loans, the question is how many loans are you going to make based on your measurement system? So if I said to you, maximize return on equity, that's the measure. That's the thing you want to focus on. Because you don't want to focus on too many things. You want to be able to block and tackle really well. So if today we're going to focus on return on equity, at what point, because we get to choose how many of these loans we make, and we're going to go that direction. So we're going to start with the first one, second, third, fourth, fifth. So if you were CLOs and you were paid based on maximizing something, and today I'm saying maximize ROE, which number is the one that you might, where would you stop making loans? And the answer is right here. Down here, these are the loans accepted, the cumulative. The maximum ROE is at 80%. So you'd stop right there because as you continue to run out, the ROE starts to go down. So if that was your only measure, you'd say, wow, we're in great shape. Problem is it's not correlated against MVA very well at all. The other issue with it is that while you have a very high return on equity, you have a very low value of the business, or the net present value of the cash flows that that business throws off. I'll give you an example. You're a paper boy or paper person. Sorry, I'll be more politically correct next time. I apologize. And I give you a quarter, and I invest. Okay, it's all equity. So you got a quarter, go forth and prosper. But you're focused on return on equity. So you take that paper and you go out and you sell it for 50 cents. So now you just made a quarter, and you have 100% return on equity. But the business has only generated 25 cents. So you feel really good about the fact that I have a very high return on equity. But in reality, if I was going to sell that business, I only got 25 cents of income. So I could go out and someone's going to say, well, it's 25 cents of income. Well, I don't know. That's kind of, I'm not sure I can get 25 cents. I'll give you 20 cents, right? So, I mean, in reality, the business has a very low value by maximizing ROE. So there's a balance. So that's one decision rule we would probably throw out if we were trying to maximize the value that we're generating for shareholders who hopefully are us. If you focused on net income after tax, obviously you'd make all 6 loans because all you're trying to do is add incremental income as fast as you can. And because we're not charging at that point, you'll see here, because there's no capital charge, because it's above that line. This is a traditional accounting measure, right? So if you're talking about just net income, this is above the line, you just keep doing it because we're not charging for the investment in the business, and because it doesn't show up as an expense, you could invest infinitely just to generate income, but in reality you're destroying value because you're taking all these investment dollars and you're not returning over what I could take that investment and do something else with it. So the right answer, without spending too much time on this, is you'd stop making loans after the 3rd one because at that point you're maximizing the value. And in this case it's 52. Okay? Yeah. Want me to go back up? Exactly. Well, if the question is on this loan, and to use an analogy, it would be like saying if you were a business owner, or if you're just a guy with a dollar, and you said, all right, I've got this dollar, and I can put it in this bank account that's got guaranteed return of 10%. And I know I can get 10% there, right? And instead, we take your dollar and invest it someplace that we get less than a 10% return. We're destroying value because your dollar is now worth less than it would have been if you had put it someplace else. So yeah, we would essentially decide to cut it off and employ the capital someplace else. So it would mean we're only going to make these 3 of these 6 loans, and we're going to go look for a different 3 loans that we can maximize the net income after capital charge. Okay, we'll get a lot more into this so that the concept becomes a lot easier to understand. Yeah. Well, it's actually the same loan, but yeah, it's got a different expense. They're all the same. They're all the same loan basically, but they have different cost components. Yeah, exactly. So NIAC's the single best measure or proxy, and the reason it's a proxy is because it doesn't necessarily mean that the value of the company is going to go up today, but over the long term, there is a very strong correlation, or the strongest correlation we can find, between generating NIAC and generating market value added. And it can be used with traditional measures like ROE if you're not allocating all the costs to the business. But NIAC is by far the best measurement. There's one failing performance, or there's one failing issue of most performance measures, NIAC included. And the reason is they're all after the fact. They're post-mortem. They don't tell us as CLOs, what am I supposed to do today? I mean, it's all, you don't know until you've made the loan what kind of income it's going to throw off. So it doesn't tell you what you did right, it doesn't tell you what you did wrong, and it doesn't tell you what you should do next time until it's already done. So what leading organizations do, the successful ones, is they develop leading indicators, or things you can focus on to provide immediate feedback and help guide your day-to-day activities. We're going to talk about that in section 3, which is how it impacts you. So now we're at the section where we're going to start talking about relating this whole idea of value to Wells Fargo and our share price. The easiest way to do this is to sort of lay out a framework. And out here in front of economic imperatives is the market. In the market, there's certain things going on in the market. Shareholders have options at their disposal. They need a certain return in order to invest in Wells Fargo, or for us to continue to be a good investment. And that generates certain economic imperatives. What kind of return do we have to return, et cetera, which translate into the strategies that the bank has to develop in order to meet those economic imperatives, which then, you start pulling this thing down, and that relates into organizational design. So we have a certain strategy, say to be in the business, to deliver business loans to small business. The way that relates to organization design is, should we do it through the branches, or should we have our own sales force in the form of CLOs? Then there's the issue of performance measurement, which is which businesses are we going to invest in, how are we going to do that? And there is actually a next level of this same logic that you'll see a little bit later. So this is the prime directive, to maximize shareholder value. If you look at December 31 of 97, Wells Fargo's market cap was $29.2 billion. We had a book value of $12 billion. We had a market premium of $16.6 billion. This is the present value of future NIAC. This is at the point usually that I have absolutely no idea what's going on in a presentation like this, or I used to not know. Because I was looking at this going, okay, I'm just going to follow along, and please, God, don't ask me a question. I remember the first time I was in a meeting with Terry, my first day as an area manager, and I go to a meeting, I think I'm an area manager now, and Terry Dial's running the meeting. And she starts talking about net present value and how we were going to start to measure the business and do different things, and she asked the question for someone to define net present value, and I wanted to go under the table and hide because it had been, must have been a long time since I had a finance class, and if I had had one that actually talked about it, which I guess it would have, but I didn't have the answer to the question, and I got called on. So it was at that point that I went and started